I am delighted by the gender composition of this panel, and B, delighted by the subject matter. So I want to kind of zoom back for a moment and just think a little bit about what we're going to try and do in our hour and 15 minutes here together. As you know, at the Conduit, we are very interested in how you achieve positive social change. We care deeply about climate, about equality, about human rights, about peace, about the empowerment of women, about healthy outcomes. And I think it's fair to say, and not many of us would disagree in the room, that the world has a series of systems that wield power in certain ways that incline themselves more or less towards just outcomes. And I think we think of ourselves as a community of people who are trying to alter those systems to try and produce the most just possible outcomes. And so we've had on other occasions the opportunity to look, for example, at the work of Client Earth. Client Earth, a group of crusading litigators who try and use courts in particular to achieve change in the legislative front, but also in the executive front, to get either parliaments or governments or sometimes corporations to behave more responsibly. And they wield that power asymmetrically, and they have disproportionately powerful results. And if you care about getting to net zero in the time that we're trying to get to net zero, you would be a fan of how Client Earth wields its power. So today we're going to have a different kind of conversation, and that conversation is about how shareholders, the owners of companies who individually might be atomized and disaggregated and not very powerful, might be aggregated together, and how their collective power might be used towards just ends. And we might discover on this panel that we don't really care about just ends. We just care about the democratic exercise of shareholder power. And if it produces just ends, wonderful. And if it doesn't, it doesn't. And I suspect we might have a debate about that. And so what you're going to hear tonight is stories of positive case studies where shareholder power has succeeded in bending corporates towards just outcomes. You'll hear stories of failures, of why it was that we weren't able to mobilize shareholders to achieve just outcomes. And what we're going to try and do by the end of it is extract a series of practice lessons for what we might want to do to accelerate the use of shareholder power towards just outcomes, how we might want to avoid failure to the extent that those failures are diagnosable or predictable. And then we're going to have a debate amongst ourselves about whether this entire exercise is about propping up an unjust system and we just are rearranging the shareholder deck chairs in a capitalist Titanic, or whether we are in fact capable of doing something radical within the system that inclines it towards justice. So with that, I'm going to start with Catherine. And what I've asked Catherine to do is to talk a little bit about the work, some of the work of ShareAction and what they have done and successfully achieved, some of the work that they've observed, particularly in the Exxon case. And then we'll sort of move down the panel and take the conversation from there.
Oh, well, thank you, Paul. It's incredibly nice to be here and at the Conduit, which I think is a place which has fostered this conversation about the role of investors in creating change and challenging the status quo in interesting ways. So we're right in the middle of company annual general meeting season. And so at the moment, as ever, ShareAction is supporting a huge number of different people to pop up at the annual general meetings of typically very large listed companies, FTSE 100s, but quite a wide range, investment trusts as well, to use the democratic right that they do have as shareholders to pose questions to the boards of directors of those companies. And I was just meeting with someone earlier this evening who happened to be on a board of an investment trust where only this morning someone who's working with ShareAction popped up, which is something I didn't know about. And she was so endorsing about the question and the challenge they had. And so it is companies have this kind of democratic structure. And Merryn will talk in a minute about how that democratic structure has been kind of disorganized in a way that's very, very disempowering to the vast, vast majority of people who, for example, belong to pension schemes or who have ISAs, who don't have access to annual general meetings. But one of the things we've done at ShareAction is to try to make sure that the fundamental democracy of company annual general meetings is accessible to people. And over the years, we've asked tons and tons of questions, and all sorts of things have resulted from, you know, one of my favorite actually is a woman a wheelchair user who went to the annual general meeting of one of the big transport companies, bus companies, and then on the spot telling her story about her experience of being left on the side of the road, secured a commitment that they would change their company policy and ensure that people who are wheelchair users got automatic access to their buses and their trains. So those kind of occasions when people turn up and actually they tell a story from their own direct experience are particularly powerful, because on the other side of the table are the directors of companies who are human beings who always want to do, you know, the best thing, I think, by the many, many different stakeholders they have. Those stories are really powerful. But I wanted to tell a quick story about our work last year at Tesco. Tesco, everybody knows Tesco, everyone's shopped at Tesco, incredibly influential company on all our lives, and in many ways very socially responsible on all sorts of fronts, very successful company. Had a bit of a blind spot though about the kind of nutritional value of Tesco food. And so after a lot of research, comparing Tesco against its peer group and challenging the company discreetly behind the scenes, building a bigger and bigger investor coalition of individuals and also institutional investors in Tesco, we filed a shareholder resolution, which is kind of a real kind of upping the ante tactic. You know, there's no need to file a shareholder resolution the vast majority of times, but when a company isn't engaging and listening, it's a very, very powerful thing to do. In the UK, it requires, unless you've happen to have 5% of Tesco shares, then you have to have 100 different shareholders come together. And that itself is an incredible exercise of bringing a group of players together. And we did that at Tesco last year. And goodness me, it proved how once you file a shareholder resolution, you really do have the attention of the board. So, you know, it can be a bit hard work getting an issue like nutrition onto the radar of a board of directors of a company that has many, many different calls on its time and issues and challenges and considerations. But filing a shareholder resolution gets everybody's attention, not just the board of directors, but all of the enormous shareholder base of a company like Tesco, because it's then on its way to going towards a vote and people will have to make up their minds, typically large institutional investors that have holdings in the company. Anyway, upshot was a wonderful outcome where Tesco has made a huge commitment to transform the share of its total food sold that's nutritionally valuable to people in the UK. That will make a real difference to the diet of the nation. Tesco having made that commitment, which, by the way, having made it, we withdrew our resolution. There's no need to go to a vote. Sometimes these things can be resolved without the tension or drama of a vote, although that can also be very powerful and interesting. And then what was really intriguing about that example is that everyone else in the retail sector then stepped up on nutrition. So it had this kind of ripple effect that I think is genuinely very positive for the sector, very positive for consumers, truly in the public interest, and in no way detrimental to the long-term shareholder return or the financial prospects of the company. So I feel that's a nice example. It's a work in progress, obviously. Let me speak also to engine number one, which probably had more column inches than any shareholder activist campaign, at least last year. devoted to it across the global media. ExxonMobil is the world's largest oil and gas company, a company that many institutional investors feel have had, the board has had its fingers in its ears as far as, really stepping up to meet not only from a kind of environmental point of view, but also from a long-term risk to the company point of view, just not engaging with the challenge of the low carbon transition. And so this plucky little hedge fund, engine number one, with a very, very tiny holding in Exxon, put forward a slate of candidates to go to the vote to be elected onto the board, and secured a level of support from Exxon's shareholders all across the world, which resulted in 3 directors joining the board who had extremely interesting and strong environmental credentials, real expertise to bring to the board of Exxon. And yeah, but it was fought all the way by the existing board, who rejected and recommended shareholders do not support these interesting outsider candidates. And so it was a fight. It was a very dramatic contest, and it was won by the little outsider, which is very satisfactory in a way. And now who knows? I mean, it's very early days as to what will happen at Exxon as a result of having directors with a different profile. And it's hard. I mean, we'll probably hear from Merryn about the experience of sitting on a board where you've got some new voices and faces come in. It won't be quick work to transform Exxon, but I think it was a wonderful example of a small outsider group with a holding proposing something which actually secured extraordinary support around the world and will ultimately lead, I think, Exxon in a different and better direction. So I think that's a nice example of activism really creating proper change.
So before we move on to Georgia, I wanted to ask one quick follow-up. One, you had a resolution that got director's appointment. One, you just had to kind of fake it and withdraw, and you got a change in corporate behavior. The test will be not these procedural tactics, right? The test will be in year 1, year 3, year 5, and year 10, how those corporates adjusted long-term for the goals that you did, nutritional value, move to net zero. And so I guess you've sat on this chair long enough to be able to answer the question that in how many instances when you've won, have you then seen over time corresponding and significant changes in corporate behavior?
Well, it's absolutely true that you need to continue to scrutinize, hold accountable, challenge, ongoing. It's not over in a day. But that is the role of shareholders, who absolutely every year can then re-elect the board, have their opportunity once a year, so that there's a wonderful forum for accountability every single year. I do think that keeps directors at it. In the case of the Tesco example I gave, they've set 5-year targets. They know that we're watching closely. They know that we have a very, very broad conversation with institutional investors in Tesco. So and by the way, we then had a site visit 6 months later to meet the executives in the firm that are responsible for delivering on this target. I was very impressed by the fact that their remuneration and incentives have all been aligned with this goal, which I think is a positive sign. But I mean, we've done years and years of work on living wage, and I think the companies that have committed to become accredited living wage employers have not a single one has turned back on that. There is, I think, a need to ensure that the company's auditors are really examining and the extent to which the living wage commitment is really in practice embedded in that company, particularly in the sort of supply chain elements of those companies. And because one of the key votes at an annual general meeting is the vote on the auditors need to keep an eye and reassure investors that companies' commitments are being lived up to. So I think there are structures in place, good ones, which have been invented over several centuries of corporate development and the development of corporate law, but corporate governance practice that are there. And I think the annual general meeting and the fact that with just a single share in the company, you can turn up and ask that question does keep directors on their toes. So I think the vast majority of the time, companies do deliver on what they've said, but they have to be watched for sure.
Georgia, you were going to give us a few examples from a range of different areas of your work where you've seen both success, but also some areas where you've seen challenge. So go ahead.
Yeah, and I think on your point, I was reading something yesterday that 94% of shareholder proposals that are of environmental and social shareholder proposals that are elected by the majority or that are supported by the majority of shareholders are put into practice by the company. So that's a stat rather than an anecdote about supporting what you were saying. So yeah, I guess, well, one example I was going to give was relating to the question you just asked, Catherine, about when maybe a vote is put to company, but then they aren't necessarily holding themselves accountable. And I think we had an example of that with Procter & Gamble, which was, again, quite widely reported on, not nearly as much as Exxon last year. But in 2020, shareholders voted for Procter & Gamble to report on its deforestation in its supply chain. Effectively, they're asking them to improve the deforestation in their supply chain. And specifically, that was in relation to pulp that they use to produce some of their toilet paper products, and also palm oil, which is in many of their other products as well. And they are using, in the pulp case, primary forest, virgin forest, to create some of their toilet paper, which we can probably all agree doesn't make perfect sense. It's not directly Procter & Gamble, but it's in their supply chain where that's occurring. So shareholders actually voted through a proposal, it got 2/3 support from shareholders, for Procter & Gamble to change its deforestation policies or to report on them and then change them as a result. And then there was a lot of talk this year about the fact that they had not done enough to actually, although that had been passed, the vote from shareholders is only advisory in most cases, and they felt like the board of directors hadn't done enough. And there was a lot of focus on individual board members this year to try, or last year in October, to try and up the ante, get them to up the ante on I guess, implementing the change that shareholders had asked for. So I guess there's an example of where you do need to hold a company accountable, and they aren't automatically going to do as shareholders have asked, especially if it's not in alignment with their strategy. There are other examples of votes that people might think are really obvious that go to shareholder proposal but don't pass. So this year there's 540 proposals were put forward. Not all of them will go to the company AGMs because, like Catherine was saying, they might get I guess, blocked by the company and the SEC, but they could also be pulled back by the shareholder who put them forward if the company agrees to what the shareholders are asking for in the first instance. But of the 540 proposals, few of them will actually be passed. And lots of those proposals will be on things that you might think are quite obvious. For example, last year, there was a vote at McDonald's, which was asking them to report on the antibiotic use in their products. And that vote only had, in 2021, I think it was 11% support from shareholders. Although on our platform, where we kind of canvass underlying investors, so those people invested in retirement schemes and ISAs, stocks and shares ISAs, for example, we had something like 93% support for that McDonald's proposal. So there are lots of instances where the large institutional investors who are voting on behalf of the many underlying investors who don't have direct influence over the vote outcomes, there are many instances where there is misalignment. And I think often that's to do with, I guess, the financial materiality or the kind of perceived financial materiality of the issue. Institutional investors have a problem, and they don't like to get overly involved in kind of what they'll deem as prescriptive issues or kind of executive issues that are to do with kind of company management. They like to stay higher level. But then I think a part of that is also to do with, where is there pressure? So we saw on the Exxon campaign, there was a lot of pressure. On the Tesco campaign, there was a lot of pressure. On the Barclays climate vote, there was a lot of pressure from media and partly ShareAction and then other kind of campaigning organizations, which mean that those institutional investors have to vote in favor of those slightly more progressive shareholder proposals than they otherwise would. So if you look at the largest institutional investor in the world in 2020, they did not support about 80% of climate and social proposals. So there are a lot of instances where these issues, which may seem really obvious to the people sitting in this room, are not being dealt with by the institutional investors who vote on our behalf. And that doesn't mean they always ought to go through. There are, of course, situations where shareholder proposals are a bit crazy. For example, I think there was one at Tesla last year or the year before on telling Tesla they should spend at least $50 of every car purchase on marketing initiatives. Super specific, not very relevant, and very over prescriptive. So of course, that might not be something that we would expect institutional investors to vote for. But in many cases, you'd be surprised by the things that I think don't get passed at companies.
So I'm very philosophically intrigued by the question that the example you just gave. So you ask pensioners whether you think it is a good idea to have antibiotics in your hamburger, and they overwhelmingly say no. The pension fund that in aggregate represents those pensioners will say, I'm going to look at the materiality of a strict ban on antibiotics on McDonald's profits over this period of time because it's going to push up the cost of our burgers, and we don't want to influence the economics of this company, even if it's in the short term, and we don't want to prejudice these pensioners who've just told us they don't want the antibiotics. And so there's a philosophical question as to on whose interests should you be representing, and what do you mean by interests? And so this has got to be at the heart of your practice.
Yeah.
So unravel that for us.
I mean, it's a really difficult question. I think there are some easy parts to that question, which is, before Tumelo, the pension fund had no idea how their pension members wanted them to vote. So that's a first kind of easy win. At least you could have some insight as to how your customers would expect you to vote on an issue. Whether you listen to them or not is now another question. So I think that's one thing, is low-hanging fruit. Institutional investors should have to understand the preferences or the values of the people who they represent. That's one thing that seems obvious and is relatively easy to do in the grand scheme of things. Doesn't require any regulatory change, really. I think after that, for me, it kind of comes back to a question of timeframes. So are we investing here for the long term or for the short term? Why are we investing? Is it about securing my outcome in retirement, for example, which is going to be financial and social and environmental, and the world that I want to retire into is not purely based on my pension income, but actually, what the environment is or the social setup. Whereas fund managers are obviously not thinking about those types of things most of the time. They are in terms of what's material to my company. So, if McDonald's has an antibiotic scare, then that's material to McDonald's because it's a reputational risk and the share price might go down in the short term. And that might look bad for my quarterly performance metrics as a fund manager, but they're not, it's hard for them to look 50 years forward because they're judged on quarterly performance or maybe annual performance. So I think, our view at Tumelo is certainly that the underlying investor should ultimately have the final say. I think if someone wants to delegate their vote to a fund manager who they have selected and who they believe knows more than them, in a democratic sense, it's like, you say, I want this person to represent me, then that makes sense. But in the system we have at the moment, everything is so aggregated and people have no idea where their money's going or who's voting on their behalf or what values those people have. I think really the default should be that someone can either vote themselves or choose who votes on their behalf. And certainly, at the bare minimum, the fund manager should at least know what the underlying investors want.
Q Merryn, who has written a book called Share Power on this very subject. So why don't you distill down the core argument in your book, but also as a person who's been sort of a well-respected journalist who's lived and swum in this world, what caused you to write this book?
What caused me to write the book? I think that the main thing that caused me to write it was Larry Fink, who is the CEO of BlackRock, which is the biggest asset manager in the world, and Larry writes letters every year to supposedly to his clients, but actually to the whole world, telling us how he thinks the world should be run, how he thinks companies should behave, what he thinks is best for everybody. And because he is effectively in control of some of the largest shareholdings in the world, everyone has to listen to Larry. So all company CEOs of big companies around the world have to read Larry's letter and think very carefully about what it is that Larry says. And sometimes Larry says sensible things, and sometimes Larry says truly ridiculous things. But everyone has to listen. The point being that Larry doesn't really he shouldn't have the control himself. He's holding everybody else's power to himself. I mean about Larry, it's not just Larry, of course, it's BlackRock as a whole and the other big asset managers. They have everybody's votes, they control them, and they're able to use them without ever referring to the underlying owners. So I think actually, let's answer this question properly by going back a little further, okay? Now, the limited liability company is possibly the greatest innovation of all time. It is the building block to everything around you, every product in this room, every product you consume, every part of your life, every iota of your wealth and well-being is based on the building blocks of limited liability companies. They allow investors to put money into an idea, into an innovation, into anything, and know that they will never lose more than the money that they've put in. Before that was possible, and before you could aggregate the investment of large numbers of people, it was inconceivable that we could have moved forward economically in the way that we have. So that is the first key point. This systematic building block is vital to every part of your standard of living. So initially, when we had our first limited liability companies, they had small numbers of shareholders. Those shareholders knew that they owned those parts of those companies. They understood that they had a degree of control over the directors who managed those companies. However, even when they were first set up, even at the very beginning, there were economists 300-400 years ago who worried that if you had too many shareholders, the directors would have too much power because the shareholders would become too diverse and the directors would be able to pull that power to themselves. Right? And that's pretty much what happened. So we gradually moved from a period when the shareholder was powerful because they could control what the directors do to a point when the shareholders were so diverse that the directors were the ones with the power. And we call that managerial capitalism, where it was the managers who controlled what happened. And that was fine, actually, for a long time because people felt that it wasn't the job of companies to do anything except for make money. So the solution was, and there was a definitive article on this in the New York Times in 1970 by Milton Friedman, saying none of this mattered because if you simply gave the managers one target and had them meet that target, then everyone would be happy. And that target was to maximize shareholder returns, to make as much money as possible for shareholders. And so we had that shareholder/managerial capitalism running for some time. Gradually, that has shifted over from managerial capitalism to what we might call money manager capitalism. So we're back to the point where we have a couple of very big shareholders who wield the power. And that is because instead of us all owning our shares individually, so go back to, let's say, the 1960s, very few people held shares. About 3% of the population held shares. Everyone else had nothing at all. No wealth inside the markets. But that 3% of people held a lot of shares. And they knew what they're doing. They had a certain amount of power. Today, pretty much all of us own shares. We own them through our auto-enrollment pension. So about 80%, that's right, isn't it, of people in work today have an auto-enrolled pension, which means that they have equities. They own shares. However, they don't, as previous shareholders did, have the power that comes with those shares. They've delegated it to the fund managers. So we're kind of back where we started, with a couple of big shareholders wielding the majority of power in the market, except for this time round, they shouldn't own that power. This time round, we have a much more egalitarian system where, in fact, everybody holds a little bit of that, should hold a little bit of that power. We all own shares, so we should all have the ability to vote when it comes to the AGM, to vote on the kinds of things that Catherine and Georgia have been talking about, but we don't. And that's where the core problem lies. And that's why I wrote the book, because for me, as I said, this idea of a democratic shareholder capitalism is an absolutely amazing system. It gives us all a stake, in the wealth of the markets that we invest in, but it also gives us a say And that's the absolutely crucial thing. And we're going through a period at the moment where people are generally disengaged from the idea of wealth creation, disengaged from the capitalism that has served us all so well. And they feel that the power rests with the small number of people, which it does, but which it shouldn't. And that's something that we can change by finding ways to return the votes to the people who own the end assets, i.e. us. And so that's what the book is about. It's about why this is important, why limited liability companies are important, why stock markets are important, why shareholders are important, and how we can regain the power. Now, the timing of the book was vital because it was at the beginning of the pandemic that we saw this huge rise in interest in stock markets among ordinary people who'd shown pretty much no interest in markets for ages. Suddenly everyone had, not everyone, but a lot of people had extra money in their pocket from the pandemic, from staying at home, from the various government handouts, etc. And they had free time. And they could see markets moving around the place. And as it turns out, they couldn't gamble on sports. It turns out that in the US, an awful lot of people who turned to the markets did it because they couldn't gamble on other stuff. But we'll leave that aside. It's not the most savory part of what I want to say. And at the same time, as we had this rise in interest in investment from ordinary people, we also had a renewed need for stock markets from companies who over a period of time before that hadn't really needed to come to the stock market to raise money because they could get it elsewhere. Suddenly they need money in a hurry. They can get it from the stock market. We saw an extraordinary number of new money raises on markets all around the Western world. And as the years went on, we saw a huge rise in the number of new companies coming to market. So we had this new rise in retail investors, new rise in new companies coming to market. It all got very exciting. Everyone got interested. And I thought, well, now is the time to explain to people the power they really have if they can just find a way to grab it. Does that cover it for you?
That's wonderful. And so I think there are two categories. So if the premise of what we are now going to move to discuss is that we have this underappreciated ability to take back power in a terrain that is associated traditionally with a alienated concentration of power away from the masses, small groups of people wielding power on their own behalf and not on behalf of all of us.
Sorry, I'm going to interrupt you briefly to say that the key point is that we don't have the ability to take it back at the moment.
Yes.
The regulatory system simply doesn't exist.
Correct,
so
correct. Exactly. So what we're trying to do is to say, what regulatory fixes might we come up with in order to rectify this? And then what are we doing as activists in the interim with the scales tipped against us, with the playing fields leveled against us, tilted against us, to try and remediate as we do it? So I know in your book you have a couple of suggestions as to what we might do, and then I'm going to come back to Catherine and Georgia to talk about what you're doing right now despite the system that is imperfect. So what would you do if you were PM for a day?
Yeah, well, I mean, the first part of that answer is extreme transparency. And that's slightly where Georgia comes in. You know, one of the things that we don't do is oblige fund managers, who we all use, via our pensions, our ISAs, etc., to oblige fund managers to give us proper, clear, straightforward information about what they're doing and why they're doing it. So that's a problem in itself, and that most people, as I say, very few people understand, even for starters, that their pension is invested in the equity market. And even if they do understand that, they have very little way of knowing which equities they're invested in, what's going on in those companies, why they hold those companies, etc. So there's a very low level of transparency to start with. So that's probably the place to start, and an obligation on fund managers to produce, when you get your pension statement, instead of just one bit of paper with a couple of numbers on it that you don't quite understand, and no transparency around anything from your fees to your investments, proper couple of pages on what you've got, why you've got it. And then inside that transparency, something on how that fund managers use their votes. How often have they voted? What have they voted on? Why have they done it, etc. And then a questionnaire to you saying, what are the things you really care about? Why do you care about them? You know, in a very general kind of way. And what Tumelo does can be quite specific, right? But a good starting point is just to have fund managers say to every investor, just tick a couple of boxes. Tell us what you really care about. And also, crucially, tell us if you care, if we go down that path, you might not make as much money as you might have otherwise. So tell us where your boundaries are. That's a very important starting point. But that aside, I think it's important for the companies as well to take action here. So most companies, a board of director, there is no director who is actively responsible for relationships with the retail investor, or indeed with the institutional investor. That position doesn't exist. So if you sit on a board, you'll have various non-executive directors doing various things. One will be responsible for the remuneration committee, one will be responsible for this, one responsible for that. But nobody is responsible for making sure that the company has found a way to directly communicate with the people who are its actual owners, not its middlemen owners, not the BlackRocks, the State Streets, the Vanguards, but its actual owners. So I think, I'm very against loading regulation onto companies, very, very against it. I mean, one of the major problems with companies coming to market is this huge slew of regulation that hits them at every turn. It's one of the reasons why we have a problem with companies going private rather than staying public. But I do think that this would be a crucial change. One non-exec who's obliged to pay attention to that particular relationship.
So I want to ask both Catherine and Georgia, because in some ways you could imagine that this transparency question that you started with would be made easier by a well-crafted law compelling just the right kind of disclosure, not overburdening, but just the right kind of law. It seems to me that you can, in a more difficult way, divine this information already in many instances and make it available to people. And then the question becomes how you get people to care. Because I think, you tell me if I'm wrong, but I think the problem is that most people who own, the 80% of people who own shares would be horrified to know what is happening, not in their name, but from their own pockets, if it were properly made apparent to them. And it is indeed possible to make it apparent to them. So why are we funding antibiotics, deforestation, drugs that kill people that pharmaceuticals companies produce, which should be healing people, all the things that we would otherwise be shocked by, that we wouldn't countenance and have the power not to countenance because we own these companies. So what's the disconnect? Why are we failing?
It's me?
Yeah.
Okay, so yes, the information from a transparency perspective is kind of available. Certainly in the passive space, you can go and search online and find out where your pension is, and then probably drill down to the fund level. And then you have to go to the websites of the individual fund managers, and you can get a view of what their holdings were maybe 6 months before if it's a mutual fund. It's really difficult. You have to be really on it to want to do that. So I think that there is a big pressure on fund managers to make that easier for people, but actually I think the pressure should lie with broker platforms. So the pension providers, the investment platforms, where people go to buy their investments, they should be obliged to make it more, that information more available to the people who are then investing in their portfolios or the funds of the fund managers. That probably requires fund managers to play ball, but ultimately, as transparent as a fund manager might want to be, someone doesn't go to the fund manager website to make an investment. They go to an app, or they go to like Hargreaves Lansdown, or they go to their pension provider. That's where their investments sit. So I think it's important that information is there rather than just on the fund manager's website. That's one thing. And that also answers your question about how to drive engagement. I think having the regulation just sat at the fund manager level is challenging because people don't interact with their fund managers, which goes back to the heart of the problem that BlackRock have no idea how to represent their customers, even if they wanted to, because they have no connection to their fund managers, because they themselves are intermediated by the platforms and the advisors and the various different intermediary stakeholders who then sell their funds or distribute their funds to users. Yes.
I understand what you're saying.
Yeah.
But I think that what I'm asking a question, which is a more simple-minded question, which is, why is it that we don't properly appreciate the moral or the causal connection between our money and these outcomes when they're actually very easy to draw?
I mean,
what are we failing to do to say, you own these companies that are doing things that you don't approve of, and yet you are passive.
But I think when you do tell people that, they do engage. Like, that's what we do. But the problem is we don't tell people. Most people don't tell people that.
Catherine, why don't we tell people that?
Well, I mean, so the vast majority of people have investments through their pension fund. And the job of a pension fund trustee, I've served as a pension fund trustee. It's quite hard work for very little money. And your job is to try and, invest in a way that will give people enough to retire on. So there's no strong temptation on their part to complicate life by presenting information to the, first of all, it's just much easier. Life's a lot easier if the pension fund members are not asking dozens of questions. And so you just get on with your job, and you can measure it quite straightforwardly by, what was the return quarter by quarter. It's a nice, easy job. And also, you feel you're doing something very important, which is giving people a retirement income. And that is a very important social function. The reality of, I guess, modern capitalism is that large companies are driven by that shareholder demand to make as much money as they can. It's a very competitive environment for capital. And so the incentives down this chain are all about profit maximization, when the actual end investors operate at their consumers, their employees, they're people with a multifaceted interest in companies behaving in a responsible way in which they don't externalize social costs by paying as little as possible, or by, polluting because it's cheaper in the short term. So this is what I love about democratizing the whole system and process, is that ordinary people can hold these things quite happily in balance, and they know that there might be a bit of a trade-off, but that's okay with them. And one of the things that confounds and confuses and horrifies almost people with jobs in the financial services industry is that when you ask people what their attitude is to corporate responsibility, people are incredibly supportive of companies needing to manage their, impacts on society and the environment. And that's really not necessarily the message that people that invest on their behalf want to hear, because that really complicates things. So what I love about Tumelo's analysis is that it's shown that fund managers are completely out of step with the sentiment of millions of people with pension savings. And that then leads to this call to, well, what are we going to do about that? How can we have a process in which it's not just a vocal minority championing one issue or another, but you really do canvass in quite a democratic way the sentiment and views, let's say, of a given pension fund, and you consider their interest in the round. One of the shareholder activist campaigns we're running right now is for Sainsbury's, and in fact for the whole of the supermarket sector, to sign up to being accredited living wage employers. And there's huge public sympathy for this right now, because the supermarket employee workforce saw us all through the pandemic at such considerable personal risk to themselves in many cases. And people just feel very intuitively that people that work in supermarkets should be paid enough to live. So one of the big investors that has backed our shareholder resolution that will go to the vote on the 7th of July, which is very interesting and exciting, we'll see what happens, is Nest, which is the largest pension fund in the UK by size of membership. So they have 10 million people in the UK are in Nest, and the vast majority of the demographic of the Nest membership are people in very, very low paid work, typically very modest incomes. And to be fair to the trustees of Nest, they have this quite enlightened perspective, which is that, well, we will vote for and really push for companies in Britain to be living wage employers, because that's really relevant to the lives of the people in this pension scheme. And if you ask them their opinion, they're really pro companies doing well by the workforce. So I think we're almost at this point, and I think Merryn's book is really groundbreaking because it really shows everybody. And your technology is incredible as well, because we're almost at this point of being able to, through tech, actually canvass the views of millions of people with exposure to capital markets, and hopefully move to an era where we better represent their interests and their preferences. The fund managers will always have a job of, making financial decisions, where to allocate capital, how to vote at the company AGMs, but heck, they should be better informed by what those real people who they're acting on behalf of, and paid very well by, incidentally, think and want. And we've got all the wherewithal. I think, and this is why your book was so well timed, because this is the moment.
Yeah, until very recently, we haven't had the technology to do any of this. During the last 10, 15 years or so, as the big fund managers have risen and taken the power, there hasn't been any way for them to share it. So, we might get on their case now about how they hold all the power, but until very recently, there wasn't a choice. And, we all approved of the way this was done, because we obviously wanted to be invested and we wanted to be part of the market. So, people like me looked at the rise of the big fund manager and the rise of the system where everybody has a stake in the market and thought this was great. But only over the last couple of years could we look at it and say, actually, we can make this better, make this much, much better by making it not just look a little democratic, but make it genuinely democratic. So you're absolutely right. It is only the last couple of years. I mean, you couldn't even have done what you were doing 5 years ago.
No, and I would just also add that we've been talking a lot about the kind of indirect investor who's represented by a fund manager, but just for a second to look at the system that exists today, which is the direct proxy voting system, where if you actually do own a share in a company, you can go to the AGM and you can vote. Even that system is really not very well organized, and the incentives, you asked about why people don't engage, are really, really poor. So in America, the largest market in the world, when you are a company and you list on the New York Stock Exchange, you make a commitment, which is managed by a regulator, that you will distribute proxy material, so voting material, to those who are invested in your company. Some of them will be to fund managers, lots of them, but some of them will be to individual retail shareholders. And it's much more common in America that someone would buy and own a share of an individual company. However, that company has to pay for the distribution, and no one at any point in the chain, the company, the broker or the agent they use to distribute the materials, which is basically all done by post still, the broker, which is like the Hargreaves Lansdown equivalent, the investment platform, no stakeholder is incentivized to get engagement. Every single one of them is paid to send a letter. So they get paid if the letter goes through your mailbox. No one gets paid if you respond as a voter. And that, I think, is a really, really big problem, because everyone's incentivized to distribute proxy, and actually they all have to pay in terms of operations if you reply. So they're all incentivized not to have you respond. And the company probably also would rather the retail investors didn't get involved. It's much more complicated. If they only had the institutional investors, they just have to go and meet BlackRock once a year. They don't have to manage a big retail marketing campaign. And I think we talk a lot about the institutional space, which we're really passionate about and is what we focus on at Tumelo. But as we've been expanding into North America, I've started to stare that problem in the face. And that is a really big problem. And I think also is a big reason why we don't see engagement in the space we're talking about. Because if people were more engaged in the shares they actually owned, then that might at least flow over into their pension funds and into their other investments. But even when people own a direct stock, they're not engaged because no one's incentivized to make them.
Little defense of the companies
sorry,
there. I mean, in fact, that if you are a company and you want to engage with your shareholders in the UK, it's verging on impossible at the moment, because you have to go via the platform, and you can't get the names of your shareholders and the addresses of your shareholders directly, and you can't contact them directly. It doesn't work like that. So you have to go through the platforms, and some of the platforms are excellent. Interactive Investor, for example, we all approve of. They've done a huge amount of work to make sure that there is a very easy way for any of their clients to vote directly with the shares that they own. But generally speaking, I sit on a couple of boards, as you know, and we would really love to have much closer connections and engagements with our retail investors. But that means that we have to work very intensely with the platforms to get any connection at all. So there's a regulatory change that needs to be made there, because the regulation system we have in place was not put in place with the expectation that nobody would own shares directly anymore, that they'd all be owned via proxy through the platforms. So there's regulatory change there, which is important.
You asked about what changes in the law we need, and I was kind of tickled in a way, Merryn, that you said, I don't approve of regulation at all, but when I look at this particular area, I think we really do need a new law. And it's true that when you start looking, we've written model legislation for pension schemes, which would require them to engage with their members, ascertain views, and then report to their members on what they did with that information. We also think that fundamentally the premise that you act in someone's best interests exclusively if you maximize their financial returns in a world of systemic risks is not in people's self-interest. Now, we need to broaden out our definition of acting in someone's self-interest to incorporate both the financial returns that are secured and the risks that are managed, but also the impact of that company on that person's life, because we are, each and all of us, impacted day in, day out by companies who are incentivized to operate in ways that are not always in our interest. And that's just hardwired into the kind of the design of the fiduciary duties of institutional investors. So there is a number of fixes, and it's kind of interesting. Well, I've been at ShareAction for a long time now, and we've run all these campaigns, and we've had, you know, tremendous success with a number of these campaigns. But the thing that we've not succeeded in at all is in this area of getting democratic reform around the obligation of people that act on your behalf to tune into what you think, to be accountable to you about what they've done on your behalf. Funnily enough, no one in financial services really wants to give up any power to end investors. Well, that's how. I hope so.
I feel change, and I'll tell you why. It's because of the ESG movement, and it's because this is too much of a responsibility for big fund managers to take. So let's go back to poor Larry. You know, he spent the last however many years writing these letters, telling everybody what they must think, and there's been kind of a niche activity for quite a long time. But now, the last couple of years, everybody's really on it. We can find all the hypocrisy in what he says. We can find the contradictions in the things that fund managers say and the things that they do, etc. So suddenly this is difficult, and all that virtue signaling is beginning to get a little attacky. So what do? You say, well, actually, I can't do all this. I can't take responsibility for all this. You people, you take responsibility for it. So you can already see that shift happening. So, for example, the letter this year explained how some responsibility was already being delegated back to some of BlackRock's clients. So big fund manager gives some power to big fund manager is not quite what we're after, but it's part of the step, and it shows the technology is available. And the other wonderful part of his letter this year that I think we all read and adored was where he said that he could see a time, maybe not right now, but sometime in the future, where even the individual investor, that's us, could have their vote back. So, it's out there, and there's a lot of regulatory impetus behind this as well, or political impetus, should I say. So certainly in the US, there are a couple of big political voices speaking out in favor of end user democracy. And the current government in the UK, I know, is also extremely interested in it. So, there is a shift here. The fact that we know that it's possible, the fact that the ESG movement has brought the ideas of different stakeholders to the fore, and the fact that the fund managers would actually at this point like to hand over a little of the power.
So in keeping with the theme of kind of restoring power to the people, I feel as though I need to hand the mic over to this audience. But what I want to do is I want you each to do the following thing before I do that. And that is, it seems to me, based on what you've said, that we are sitting on a potentially radical possibility of exercising citizen power to achieve social ends in ways that are completely underutilized. And so, as people who care a lot about this and who have been architecting this, there are people in this room who each have their bugbear issue, and they care about accelerating change on those issues. And I think what they're trying to think about is, how do we translate the latent power in the hands of passive pension holders into the kinds of change that we as activists care about and think is really necessary? And just give 2 or 3 ideas for how you break through that kind of sludge that we're in, that moment where there is this incredible demobilizing gap between the potential of power and the actual exercise of it. So how should we be thinking of this moment?
I can start with that. I mean, I think I slightly answered you already with talking about the non-executive and about extreme transparency, and there are various other ways, tax changes to make sure that different types of companies come to market, etc. But one thing I think I should probably make clear from my point of view is that I'm not an activist in any way. And I'm a Democrat. And what I'm looking for here is everyone to have the say that they want to say. I'm looking for any particular outcome, and I'm not expecting any particular outcome. And, you know, we're talking here about the various social justices or social outcomes that people might think that they want. But as in politics, if you let everyone have their democratic vote, you have no idea what the outcome is. And you may hate it. You may hate the outcome. And you may hate the outcome, but you may all hate the outcome. But, you know, that's democracy for you. People may not vote for the things that you think they will vote. It may be that when faced with the choice between investing in what you might think to be an environmentally, socially, and government compliant approach and making more money, they go for making more money. It may be that if they're asked over the years if they would like oil companies to just keep getting that oil out and paying the dividends, or if they'd like more wind turbines to go out, they may say, just send the dividends. You know, so let's not make any assumptions about what this new world of democracy that I would like to see might result in. I think that's really important.
I'm just going to say that I think Merryn is an activist, although she doesn't own the possibility that she is, because she's an activist for democracy. And by the way, when you think about democracy in the political realm, it was activists who championed and demanded that, you know, people that pay tax should also have the opportunity to vote. And finally, that women, God forbid, would also have the opportunity. That was activists. And we're now in a world in which companies shape our lives in ways that they didn't before. And we need a democratic revolution in the investment sphere, without a doubt. And it needs activists like Merryn and me and Tumelo and Georgia and all of you, because it's not going to change without pressure. And I fully accept that it's in the nature of democracy that you don't know what people will choose. What is very interesting when it comes to corporate behavior is that actually there's an overwhelmingly strong consensus in support of companies behaving responsibly and, you know, not exploiting people in what they do. And if that does mean slightly lower returns, then a huge number of people in sophisticated trials are up for that. They don't like free riding, they don't like unfairness, but people are very happy to acknowledge that you might have to have some constraint on profiteering in order to live in a society where companies build wealth, make amazing things, but don't impose excessive costs on vulnerable parties. But yes, we don't quite know what people would choose, but what we do know is that fund managers are choosing on their behalf without their consent, and that's not okay. So I think you are an activist, I'll just say that.
Not an activist.
So I guess in terms of ways, I think we're actually not as far away from this world that we're talking about as it might seem we are. I mean, Larry's letter talked, I think the word he used was like, if you're a retail investor, I urge you to ask your fund manager for a role in the proxy process. And obviously BlackRock better hope that doesn't actually happen because they don't have a plan for that. But
Oh, they do?
Oh, well, ish, yeah. So I think from our perspective, like there is a really big user experience gap, which I know is, I'm going to say that as a tech person, but it's aside from Interactive Investor, on almost every other platform, it's really hard to vote your shares, even where you actually already have that right. And changing that is a really simple step. The stewardship code, which is the thing that all the fund managers want to be able to say they sign up to, Principle 16 says that fund managers should ask their clients or beneficiaries what they think about ESG issues. That and/or is really important because it doesn't say and, it just says and/or. So they could just ask their clients and they don't have to ask their beneficiaries. So there are like small pieces of like language that we can change in some of the regulation. And I know that's a lot easier said than done, but that would, I think, go quite a long way to making fund managers create change. And I guess the final thing I would say is, you know, we already are in lots of conversations with, especially passive fund houses like ETF providers, about how they can democratize their vote to the underlying investor. Because we're talking about voting as if it's this thing that fund managers love to do. It's not. it's a cost center for them. And they have spent the last couple of years building stewardship teams so that they can pitch the idea that they really care about voting. But for a long time, they have not paid very much attention to voting, possibly to CEO pay and director votes, but not to the other issues. And you can see that in the track record of all these investors, which has suddenly got so much better in the last 2 years. But before that, clearly it wasn't a priority for them. And most fund managers outsource their voting to just 2 proxy advisory firms who automate all of the voting for them. And they have 97% of market share between the 2 of them or something like that. So they're also defining outcomes if we're starting to talk about stakeholders that have too much power. But I think for the ETF managers who are blanketly outsourcing their vote to an ISS or a Glass Lewis, it's not actually that hard an ask for them to outsource it to someone else. They just need the technology to do that. And that is actually not that hard to build. So I guess that would be my final
And you may
comment.
have built it.
Yeah, I shouldn't have said that. But
I'm going to say you've built it. Okay, we're going to hand over to the audience for some questions. Please start in the front. Yeah.
Thank you. I'm Rebecca Warren. I'm a long-standing activist for ShareAction, and I'm also on the board. I was at the AGM of an investment trust this morning, and I suspect I'm probably the person Catherine is thinking of. Yeah. Really, I wanted to ask Merryn a question because I regularly read your columns. Here's one I cut out earlier.
Thank you. How much do you hate them?
But, the first point I'm going to say is probably going to sound negative. I'm just being concerned over the past year or so. You seem to be on a one-person mission to undermine ethical investing. Now, that possibly isn't your intention, but that was the impression I've been getting from your articles. I accept you're an activist for democracy rather than speaking for ethically investing. But if we just go back to the point about democracy, and going back to the very last line of this article, which was in Saturday's Financial Times, it says investors should think. The trouble is, if you talk about individual retail investors and about small charities who've got endowments as well, that most people don't actually have that much time to think. They do need some help. And so you're a very influential person. You've got a column in the Financial Times. You're the editor of the magazine as well. Well, what do you think you can do to help? In really extend that right to vote, but also give people the resources they need to actually exercise that vote properly. Yeah, I think that's the point I'm trying to make.
Okay. I think actually the question I've kind of answered already, because again, it comes back to the things, how do we get a democracy going? So let me go back and answer the first part of your question, which is, am I a one-woman campaign against ESG? Yes. Absolutely, 100%. I am a one-woman campaign against greenwashing, against box ticking, against virtue signaling, about an entire industry that is built up around pretending to be good, and it's a marketing campaign. It's a huge marketing campaign.
I did actually say ethical investing. I didn't say ESG.
Well, the article is about ESG, but ethical investing again is vague, is impossible to pin down. There's no way to decide what it is. One person's ethics are another person's not ethics. We have no idea what this is. So when it comes to ESG, which is what I've been writing about a lot, what I'm saying is exactly this. Big institutional investors spend all their time ticking piles and piles of boxes. We've done this, we've done this, we've done this, we've done this, but we haven't really actually done anything in particular. What we've done is we've outsourced to this, we've arranged it so everything fits into boxes, but we haven't actually thought about what is right and what is wrong. So one of the things that I write about in that particular article is that, for example, even after the war in Ukraine had begun, Russian oil companies in general had higher ESG ratings than North Sea oil companies providing the majority of gas to the UK. Now, does that show that someone has been thinking, or does it show that someone has been ticking a lot of boxes and coming up with nonsense? So that's what I'm against. I'm against nonsense ESG.
Okay. Doesn't seem to be a problem with being against nonsense in ESG, but go.
Thank you. I'm Barnaby Wiener. I work for a fund management company, not BlackRock. I find whenever I meet people who don't work in the industry and I start talking about what I do, in 9 times out of 10, their eyes glaze over and they look for someone else to speak to. And the sole individual who wants to carry on the conversation wants to talk about their latest purchase of Bitcoin or Tesla or some other spivvy stock, and their investment time frame seems to be measured in days. So I'm just thinking sort of about the issue at hand here. If we were successful in creating the plumbing to enable true shareholder democracy and allow end investors to vote, I just wonder what the take-up would be, and what we could do to perhaps encourage more ownership.
I mean, I think that's a very interesting question, because it's a question that I'm always asked about the book, and George may have a better answer than I have. But it's a question people always ask me, which they say, why would anyone care? Most people don't care. They don't. Even if you explain to them that they own shares, they're not going to vote. And that may be true. That may be true. I mean, there's the thing, we really don't know yet, but we don't know because we haven't tried. We don't know because we haven't explained it to people. We don't know because we haven't told them that they're owners. And I suspect when you tell people that you work in finance, they don't think to themselves, gosh, that's really interesting. I bet he knows a lot about vaccine development at Moderna. Well, that's so interesting. I bet he knows a lot about agri-tech. I wonder if he can tell me about those, new seed drills. Or I bet he knows a whole lot about the way supermarkets work under the bonnet, etc. But you do, right? Or I really hope you know some of those things, right? One of the things that the finance industry doesn't advertise is the extent to which it supports the economy. And I, as you know, sit on the board of a couple of investment trusts. And when the first investment trust that I joined, almost immediately we went on a director's trip, and people disapprove of director's trips. And I tell you what, I used to really disapprove of director's trips. I thought they were a total waste of shareholders' money, etc. But then we went off and we went to Denmark, actually. And we visited 5 or 6 of the companies that we held in our portfolio in Copenhagen. And I thought, God, I wish that I could show all this to our shareholders, that they could see the company that we're going to that makes the yeast that goes in the yogurts, and they could see the company that we're going to that makes the special little widgets that go in the airplane engines, etc. And I would have liked us to be able to film it all. Companies don't like that, and show it on the website to all our investors, so they can see that this isn't about money. Of course, it's about money in the end, but it's about making stuff and doing stuff, and it's really interesting. And I suspect that's where your problem lies, and I can help you with your conversational skills if you like. But maybe there are different places you can start to explain what it is that the industry does.
Catherine.
I just wanted to say, I already mentioned the suffragettes earlier, who are great heroines of mine, but I did a little bit of analysis a few years ago about all the reasons that people put up 100 and something years ago why women shouldn't get the vote, and they amazingly closely replicate all the reasons I've been given by why pension savers aren't interested, wouldn't know what to ask for or vote for, or just don't have the skills. It's just incredible how people that hold that power can invent a huge number of reasons why other people shouldn't have it and shouldn't have those privileges of the opportunity to have a say and feed in. So I'm a real believer in pension savers having all kinds of interesting views. Now, that doesn't mean that they're going to want to vote on every single vote. That's unrealistic and not appropriate. And no, they don't want to do that, nor should they have to. But I think being able to signal in broad brush ways what their preferences are around key issues, and then being able to kind of do that in a live and interactive way, which is what Tumelo is enabling, is completely within people's grasp and very doable, and would inform decision making, and then the ability to ask questions and challenge afterwards. And I still think it's a good thing that you still have the right. It's probably much more complicated because of security issues, but you do still have the right to just turn up in the House of Commons and ask your MP how they voted on stuff and what they're getting up to on your behalf. And we should have a similar arrangement. We have pushed very hard for pension fund AGMs as well as for company AGMs, so that you can go and ask the trustees how they exercised rights upon your behalf. Oh my goodness, there's a lot of reasons given why we shouldn't have pension fund AGMs, I can tell you. And they don't really stack up. I just think we should be really expansive, really ambitious about injecting democracy in every way we can possibly imagine into the system.
Well, I guess back to my point about making it really easy, I think when you make ordering a taxi easier, or ordering food easier, people do it much more often. And that's something that I think we will see with voting. But also, if you can move the power, shift the power from the fund manager to the underlying investor, then suddenly the fund managers are much more accountable. If you have that transparency, then even if the vote stays with the fund manager, but just the idea that it could sit with someone else means that the fund manager is much more likely to covet it and to be responsible with it, I think, in the first instance. And then there's a whole lot of fun product things you can do. Like, you could have people sign up to voting policies that they feel represented them. So if you're really passionate about Amnesty International and that's where you give all your money or spend all your time, they have a voting policy on their endowment, and you could just as well have your shares voted in that way as with BlackRock. And similarly, maybe you want to sign up to the Greta Thunberg policy or whatever it might be. But I think there's quite a lot of ShareActions potentially. Like, there's a lot of fun things that you could do to make this really easy for people, give them the power, give them the influence, give them the direction, without them having to do 40,000 votes a year. And hopefully, I think there's a bigger win here as well, where we can actually engage people through voting, and in doing so help them understand how important saving is and how important finance is, because we haven't talked at all about this problem, and it's obviously not the topic of this debate, but people are not saving enough. We have a huge retirement savings problem because people are disengaged. Now, people are not voting enough, and we have a huge voting problem because people are disengaged. But if we can intertwine those two issues, then maybe we can start to bite off some of the challenge in the saving space as well.
I think there's a very interesting nexus between democracy and outcomes, and it's been evidenced on this panel. If you could sign up and say, I'm always going to vote, and I'm always going to exercise my vote in favor of net zero, human rights, anti-slavery, no antibiotics, or I'm always going to exercise my vote in terms of maximum shareholder returns, extraction come what may, more drilling and more oiling, and I'm always just going to do that, right? I bet you anything you want that the more you democratize, the more you incline outcomes to more sustainable, thoughtful, trade-offy outcomes than profit maximizing in the narrow sense. And that's, again, a validation, and empower citizens, and you produce more progressive outcomes, which is good news for progressives, actually. Wow. Please, ma'am, you over there. Yeah. Why don't we do like a cluster of three, and then people can pick, please.
Yeah, I think it really depends on the questions I think it really depends on how you ask the questions, because I believe in a democracy, but I didn't really like the referendum, and I didn't like the outcome of the referendum for Brexit. And I think because the wrong questions were asked, and I think it's the same for activism. I think if you ask someone, would you like, dividends from oil, or would you like, turbines, they're going to give you the wrong answer, not the answer that you necessarily want. So I think it's really important that you ask the right questions to get what you want.
Thank you. Okay, there for you,
Right? Okay. I think there's a big important distinction between greenwashing, which I think it's very important to have a close look at, and ethical investing. And I think to bracket the two in the way that Merryn did is doubtful. But my question is about democracy and the levels of democracy. I have to say, I think it's a fantasy to think that in the best of circumstances, any more than a tiny proportion of people who have some investment in pension funds is going to take an active interest. So my question to this is about the intermediaries like ShareAction, which, by the way, as Catherine knows, I'm a big supporter of. But what are your levels of accountability? And as you proliferate and other bodies come in, how do you think their accountability is going to be developed?
Thank you. Perhaps I have a solution to some of the problems we're talking about. I think in terms of mass ownership, I think we have to make a distinction between authorized funds and pension funds. we do have more information. We have assessments of value. So we can influence the fund managers because we have more relevant and readily available information. Whereas from pension funds, what you discussed, the pension trustees, they have to assess their own, from what I understand, their own delivery of service, but we don't have the same information of the funds that they have. So going back to the power of the people, we can vote with our feet and with our clicks on the on the computer by switching between the funds that we don't like. So I think the problem here is particular with the pension funds. I love the article that you wrote on ESG. Those are the best things you have ever written. Thank you.
Do you want to just take a couple more reactions? Let's take a couple more, and then I think we can, please, yeah.
Hi, my name is Adam. I work at London Stock Exchange Group. Do the other two panelists share the perspectives, a skeptical perspective about ESG, and what about the forthcoming kind of TCFD net zero regulation? What are your views about to what extent ESG in that regulation empowers shareholder activism? And can you also provide some context? How does the UK and its capital markets and shareholder activism and retail investment compare with other developed capital markets, and why? What's missing in the UK? Thank you so much.
Let me start with yours, and I'm very interested in Tom's question about accountability as well. I think it's really key. So no, I'm not. I'm a complete cynic about ESG, but I fully acknowledge that there's a major issue of marketing and excessively cheerful marketing from the fund management industry, which incidentally responds to the fact that there's huge and growing consumer demand for investment that takes account of its impacts on the world. So one of the things I'm most proud that ShareAction does are these rankings of the responsible investment performance of the largest fund managers, because there's just nothing more important than creating transparency about whether, that the approach is authentic and really lining it up against the marketing speak. I don't think an organization like ours, although I think that's a brilliant thing that we do, can be left to do that alone. I think that this is a highly regulated sector with powerful financial supervisors, and I'm very encouraged that the Financial Conduct Authority has started, belatedly, but started definitely to take greenwashing really seriously as a concern, because they see it as quite rightly, as a mis-selling scandal in the making. So that's good. Now, I just wanted to address your challenge, Tom, about accountability of our organization. I mean, we're an NGO, we're a tiny little player relative to the vast investment firms that we interact with. But I think it's fair to say that over the years of sort of building a bit of a profile and building momentum around some of our campaigns, we've built a bit of influence. And so we too absolutely need to be accountable and transparent. So I'm thinking at the moment about our next 3-year strategy, and I think I've been thinking hard about how do we become more radically transparent and more accountable ourselves in all that we do. Haven't completely defined what it looks like, but I think to the points made earlier, transparency is an incredible, sunlight is the best disinfectant, a wonderful phrase that I have always loved. And I think we just need so much more sunlight on everything that goes on in fund management, which is the most intermediated area of our world, probably one of the many. So I am an unapologetic champion of, shareholder activism and ESG. But the whole area does deserve a great deal of challenge and scrutiny. But I think coming from a position of acknowledging that it's based on really trying to deliver what lots of real investors want to see happen in their companies and in their investment funds.
I think so on the accountability point as well, we started off building our platform for retail investors and pension members, the people who you say are just unlikely to engage, which is hard to get them to engage. Hopefully we can get the proportion higher than a couple of %, but it is true that it's difficult. Sometimes though, when we launch, we have kind of 25% of a workplace engaged, just to kind of set the bar, like it is possible. However, what we have noticed in the process is how little information and transparency the intermediaries have. So financial advisors have got no idea how their fund managers are voting voting when they pick a fund. We have given dashboards to trustees, pension trustees, so that they can review them before we launch them with their scheme members. And they've returned the platform to us and said, no, we don't invest in this stuff. You check again. It was like, no, you do. This is what's in your funds. And the pension trustees themselves, they're strapped for time, they're not paid enough, whatever the reason is, they also don't have the access to the information that they potentially need if we think that these things are important. Certainly they don't have reports on how asset managers are voting. And that's a big thing about what we're doing at the moment, is creating a platform that allows a trustee to more easily analyze how has a fund manager voted on climate issues over the last 20 years. One of the things that's really interesting that's come out of the data that we've got is that, so forget end user votes for a second, because there's misalignment between end users and fund managers, and we know that. But actually, you can have a pension trustee group might delegate to multiple fund managers on behalf of a member. And then those fund managers are actually voting in opposition on, issues like climate or human rights or equality. So, basically you're cancelling out any influence that that person's money might have, and they're paying for stewardship that basically is worthless because it's being cancelled out. So there's lots of problems with intermediaries not having enough information, I would say, and I do think that's work that needs to be done. It's not all about the end investor.
I'm going to give you the last word because we're out of time and Freddie's staring at me. So you're going to have, it's a risk, but I'm going to pass it on to you.
All right, but what's the question? Okay, let me go to the accountability. In fact, let me just answer your question very quickly on other places. The problem is the same everywhere. There are some regulatory differences where the platforms have to offer a little more information here, a little more information there. But the problem of shareholder democracy being diminished everywhere is it's across the board. On accountability, I think this is a very, very important one, because there comes a point when activist groups can edge towards being undemocratic, because if you look at the number of activist groups there are working around the world putting pressure on companies to do various things, there's somewhere between 250, 300 different groups pushing various climate things, social justice things, etc., most of which are incredibly well intentioned and looking for the right thing. But in a world where companies are dealing with deglobalization, huge labor problems, pandemics, supply chain issues, high levels of inflation, etc., there may come a point when we're asking companies around the world to do too much, and we're asking companies to take on the responsibilities of governments, because there are two levels of democracy here. There's the level at the government level, and there's a level at the corporate level. And perhaps we need to remember that we can't ask companies to take on the role of governments.
Ooh, we can ask companies to behave well in the world.
The last word. You said I had the last word.
You can't let those last words stand at the Conduit. The problem in the world is not too little activism around climate in relation to corporates. Not at all. But I'm so grateful for this conversation. A more eloquent, thoughtful, expert group of people you would find very, very hard to assemble. So, and the quality of the conversation has been remarkable. And it makes me think that we have scratched the surface in terms of the potential for social change. And this is an arena that I think those people who care about capital inclining itself both towards profit and towards stakeholders and towards positive social outcomes should be investing a ton more energy in. And I'm grateful that you are all doing it in your different ways. I feel as though there's an itch that hasn't been insufficiently scratched in this audience. So on the third floor, we all go up and have a drink and get together and keep the conversation